Within the next decade, India is positioned to reshape global capital flows in ways we haven't seen since China's emergence. The question on every investor's mind is, when does India reach US $10 trillion in size as an economy? Welcome to India Avenue's Harnessing India podcast series. I'm Mugunthan Siva, and we're here to decode the forces shaping India's economic transformation and help global investors to navigate one of the most compelling growth stories of our time. Today, we're examining India's journey from a 4 trillion economy to a 10 trillion one. More importantly, we'll explore how it gets there, because understanding the path forward matters as much as the destination itself. Firstly, we're going to look at the foundation. India today has crossed the 4 trillion GDP mark, but what makes this milestone significant isn't the number itself, but how we got here. India of today has 5 foundational strengths that distinguish it from previous growth phases. Firstly, a young, expanding workforce. While much of the developed world faces demographic challenges, India's working-age population continues to grow. Second, digital public infrastructure that's unmatched globally. UPI, Aadhaar, GST, ONDC, and account aggregator are converting demographic potential into measurable economic output. Third, a broadening manufacturing base. India is diversifying beyond its traditional service sector strengths. Fourth, corporate balance sheets are at multi-decade strength. Indian companies are financially healthier than they have been in generations. And fifth, a domestic investor base that now anchors market stability. The foundation of domestic capital reduces volatility, provides market resilience. 5 factors create a more confident, more formalized, and more productive economy. This foundation sets up what comes next. So section 2, we are going to talk about allocators and the most frequent question they ask: when will India get to this 10 trillion GDP? We feel it's on track to reach this level between 2032 and 2035. Let's break down this timeline. 3 scenarios emerge based on different growth trajectories. Scenario 1. By 2032, if manufacturing, exports, and private capex accelerate beyond current trends. Scenario 2. By 2034, if growth remains steady and broad-based at current levels. Scenario 3, it will be achieved beyond 2035 if there's global shocks or energy disruptions which slow down current momentum. However, the direction is clear. The debate centers on pace rather than the outcome. And understanding timing matters for sector rotation, valuation expectations, and identifying where investment opportunities emerge first. Let's look at the growth math right now. Let's examine mathematics, therefore, behind the trajectory. The move from 4 trillion to 10 trillion requires India needing real GDP growth of 7 to 8% and nominal GDP growth of closer to 9 to 10%. Whilst these numbers are ambitious, they're consistent with India's structural trajectory. They're grounded in demographic expansion, productivity gains, and formalization of the economy. The infrastructure is being built, the reforms are progressing, the capital is mobilizing. This is mathematics in motion. Now let's talk about some of the structural engines that will help us to get there. 4 structural engines underpin India's growth trajectory. First, demographics and productivity. Digital infrastructure, which includes UPI, Aadhaar, GST, ONDC, an account aggregator, is converting demographic potential into economic output at scale. India has the population. It now has the systems to unlock productivity. Second, manufacturing and supply chain diversification. China plus one has become a capital allocation reality. India is scaling up in electronics, semiconductors, renewables, defense, and pharmaceuticals. Supply chains are actively shifting. Third, infrastructure and capex. India is executing its largest infrastructure build-out in modern history. Public capital expenditure is now crowding in private investment, rather than displacing it, creating a powerful multiplier effect. Fourth, domestic financialization. SIP flows, pension reforms, rising insurance penetration are creating a stable pool of long-term domestic capital. This makes India's markets less vulnerable to foreign sentiment shifts and more grounded in domestic conviction. Okay, next we'll look at where the next 6 trillion comes from to take us from 4 to 10. 6 sectors are positioned to drive this growth. Firstly, financial services. Credit penetration across India remains low, representing a multi-year compounding opportunity as formalization deepens. Manufacturing and industrials. This sector could accelerate India towards the earlier end of the time. Manufacturing momentum is a key variable to watch. Technology and AI. With the world's largest data pool, India is positioned to become a significant player in global AI development and deployment. Healthcare and pharma. India is moving up the value chain from generics to biologics, R&D, and medical tourism. Consumer and retail. As per capita incomes move from $2,500 US to $5,000 US, discretionary consumption accelerates. This income range marks an inflection point in spending patterns. Infrastructure. Continued momentum in logistics, connectivity, and renewable energy provides essential support across all sectors. Now we look at what could provide acceleration as well as risks to our forecasts. Let's examine the accelerators and risks to this trajectory right now. Key accelerators include higher female labor force participation, faster formalization through increased tax compliance, AI-driven productivity gains across sectors, and sustained infrastructure momentum. The risks: a global recession would impact export-oriented sectors. Energy price shocks remain a concern given India's position as a net energy importer. Climate disruptions pose real challenges, and skill mismatches between education output and industry requirements need ongoing attention. However, India's macro buffers, this is strong foreign exchange reserves, low external debt, and diversified growth drivers, provide meaningful resilience. So what does this all mean for investors? For global investors, India represents an important portfolio consideration. At India Avenue, we believe India is transitioning from a cyclical emerging market to a structural allocation, moving from tactical exposure to a core portfolio position. 4 factors support this view: higher and less volatile earnings growth compared to traditional emerging markets, lower correlation to global equities, providing genuine diversification benefits, deepening domestic liquidity that reduces market volatility, and a broadening opportunity set across multiple sectors. As India moves towards US 10 trillion economic size, the investable universe expands in market depth, sector diversity, and global relevance. So to summarize, India's journey from 4 trillion to 10 trillion is driven by structural factors of demographics, digital infrastructure, manufacturing expansion, and a growing middle class. The trajectory is clear. The timeline is debated. The investment question is, how does this fit within your portfolio strategy? At India Avenue, we help global investors navigate this transformation with clarity and discipline. If you'd like deeper insights on sector-specific opportunities of how India fits into a long-term asset allocation, we welcome the conversation. Thank you for listening to the Harnessing India podcast series. We'll see you next time.